to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and Head of Research at analyst firm Aegis Equities, Head of Quantitative Strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights called Quant Rocks for Selecting Stocks. This is actually the first in a three-part series on a deep dive into quantitative analysis and how it's, or what it is, some explanations and examples of how it's used and why it's used, and then of course how it's applied every day at Nucleus Wealth. So a big welcome to you, Damien.
Thanks, Tim. Just want to highlight as well, Tim's chosen the name for this series. He's taking full responsibility.
I just want an excuse to use that picture, to be honest. But anyway, there we go. So look, to kick us off, we'll run through a quick agenda for what we're talking about today. So, of course, we're going to break down exactly what is quantitative analysis as a bit of a 101. We're going to discuss data and the term garbage in and garbage out. Of course, where quantitative analysis works and doesn't work. And of course, then finally, how Damien uses quantitative analysis every day in the portfolios at Nucleus Wealth. So, with no further ado, let's jump into it. Now, just before you start there, I'll read through a quick one from Investopedia here on quantitative analysis. So, Investopedia defines quantitative analysis as referring to an economic, business, or financial analysis that aims to understand or predict behaviour or events through the use of mathematical measurements and calculations, statistical modelling, and research. So that's what Investopedia thinks. How about yourself there, Damien?
Yeah, look, I'm going to start with the sad news that unfortunately there isn't a magic formula to beat the stock market, or if there is, there's people who are sitting on an island somewhere and haven't shared it with the rest of us. I think there's certainly the idea that these models will help, but they don't always help, and they generally work on a percentage basis. You keep doing this enough, and if you play the right, you play the odds.
Yep.
But if you're in there, so it's sort of a bit like the casino. If you're in there, actually, you are the casino, and you've got lots, hundreds and thousands of gamblers all gambling away. You're gonna win out on aggregate, but an individual gambler can do really well.
Yep. Okay. Sure.
So it's just sort of that part about the quant is basically saying be the casino, don't be the gambler. And so if you're coming in there saying, oh look, I've used my quant and I've chosen this, and I've worked out that next on the roulette table number 9's coming up, chances are you're not going to be wrong.
Yeah. So, right. Okay. Yeah. All right. Well, it's a great analogy to kick us off. Sure thing. And just in terms of there being so when you say long-term and short-term models.
Yeah, so there's two sort of real distinct areas of the market. There's people who try and use it and for some of the high frequency tradings and the intraday type trading strategies, and then there's people who try and use it for the long term.
Sure.
And it's relatively distinct in terms of the types of things you're using for the short term trading. is very much you're back testing these things and you're changing your models all the time, and you're sort of fighting the battle of the machines in terms of who's the fastest to the trade, and can I sniff out somebody else doing something? Does this look like somebody else is buying and I'll jump in and get in before them and wait till they buy and then pull back out again? There's a lot of sort of issues with those short-term models, and I'm going to sort of push all those aside and talk about the long-term and how do we use it as a fundamental thing rather than how do we use it as a war of the machines, so to speak, at that high frequency level.
It sort of just turns into an arms race otherwise in the short term.
Yeah, and the average person, has just got no chance of...
No hope.
Yeah.
Okay, very good. Sure. So I guess before we dive into why use quant, I guess the other side of it is, as in the positives of why use quant is why would we bother using quant when there are so many other methods of stock picking out there?
Yeah, sure. And so I've got like a list up on screen for anyone who can't see it, sort of just a number of, just a pick 10 sort of key behavioural anomalies out there that we know exist, and there's another 20 or 30 sort of sub parts to these as well, where people just get confused, and they get their brain sort of works against them, and there's sort of all these biases. So confirmation bias, people have this thing that you want to search out things that help fit your story, and if you haven't got any numbers telling you that that's not all right, you
find some.
You find some. That's right. So you start and you go, oh look, I buy this stock because it's average quality, not that particularly good, but wow, it's really cheap, and so I'm just going to buy it and write it up. And you're right. The stock up goes the stock, and the next thing though is in your own head you start going, wow, this stock's just doubled. Maybe it is a really good quality stock, and the whole story about this, and you start looking for things that confirm your bias, and it's part of that. The numbers may not have changed at all, but your view of the stock's changed just because you've had such a great experience with it.
So there's some emotional as opposed to impartial sort of grounding that you're finding.
Yeah, absolutely. Yep. And that sort of differs to other stocks where you've bought them because it's a high quality exposure and you're expecting it just over time to grind higher, and you might want to keep on holding onto those. And so, is the question about using the quant to then say, well, look, don't sell it. You actually bought it because it's a long-term holding, and you think that the quality is going to keep going, and as long as the quality hasn't changed, well, yeah, do hold it.
Okay.
So it's just trying to use the quantitative analysis to get over those types of biases. So there's a whole bunch of other ones in there in terms of things that people have in terms of biases, and things about recency bias is one of those ones where recent events tend to overwhelm the longer term ones. And that happens all the time in the stock market. A great positive news in the short term, ignores the terrible history and sort of gives you that bear market rally, or vice versa. The stock that's been beaten down and actually finally starting to have some good news, and everyone's just like, oh no, it's a terrible stock, don't believe it.
Yeah, okay.
So you need that sort of quantitative analysis to say, well, the quant is now telling you something's changed, despite the fact that you've got a different view because of how you've been burnt by it in the past or whatever.
Yep.
You need to use that quant to sort of wake up to your own biases.
Okay, sure. So we might just we'll leave the rest of the behavioural and psychological ones there. But of course, if you want to check any of those out, feel free. There's plenty of reference material out on the internet, and we'll probably be covering some more further in the series as well. So, but we will jump into I guess what is a broadly an academic view. So hang on to your hats, everybody, for this slide. But
there's a couple. Yeah. So I wanted to start in terms of this. What is quant? I just wanted to start with a really quick overview of where the academics have taken us, and then where people have sort of led on from there. And it starts with this capital asset pricing model 1960s came out with, and basically one factor is that you can describe a stock as being the market return, so some sort of beta to the market, so it either grows faster than the market or slower than the market in terms of share price, and then some sort of alpha factor. So the theory sort of seemed really nice and seemed to fit and all that type of stuff, but you had some big problems. So individual stocks, if you measured when you actually start looking at beta and trying to measure it, is really bad. So you get ones where you measure beta on a monthly basis, and Kodak's a sort of famous example that people would use within academic circles of beta of 1.25 if you measured daily, which is basically saying it goes up 25% more than the market, so it's much riskier than the market.
Yep.
But then if you measured over exactly the same time period, but you chose chose to measure it monthly,
Yep.
you'd get a beta of like 0.9, and so means it's much more conservative.
It's actually
for the market.
lagging the market.
Yeah,
Yeah.
it just sort of it wouldn't rise as fast, wouldn't fall as fast.
Okay.
And so you've got this huge disconnect, exactly the same time frame, just choosing whether do you care about monthly or do you care about daily returns.
Interesting.
And then you get back to the if you actually jump into the statistics of these things, people run all these betas and say, here's the beta of this stock. If you jump into the range and look at sort of things like R-squareds and what your range of error is, the range of error is enormous that it's using. And so people have this faith in beta and put it into these models, but statistically, it's just junk data. It's a random pattern, but I've chosen a beta of whatever because that's what.
Once a bit of confirmation bias even in the figures there. Just found something that works for you.
Absolutely.
Yeah, right.
And so then we go on to the next. So that was sort of the 60s, and still, there's still lots of people who like to use that even today. But then we had this Farmer and French were the sort of key ones that came out with some of these quantitative factors. They started with a 3-factor model and then updated that in 2015 to a 5-factor model. And so they basically said, okay, well, if I look at size as a factor, so and their thing was that small caps outperform large caps, and then if I look at value, and they used price to book as their measure. So basically, a very basic measure of a company's actual value.
Sure.
And so they came back and said, okay, if I do that though, then I end up with this model that outperforms over time.
Okay.
Then things went on and it didn't perform as well as expected, and there's a number of issues for that. But then we added profitability as another measure. So how profitable, what type of earnings margins is a stock making, which I've got some sympathy for. I actually dislike their method.
Okay.
and the investment factor, which is basically asset growth.
Right.
So for me, profitability very much matters for the business model. So some of these measures where you say, if I've got a company that's a service company, sometimes I can earn really high margins because I didn't have to invest very much for this, but it doesn't mean that business is necessarily better than a manufacturer that might have quite low margins because it's got this huge capital expense and it's got this big depreciation. But there's a question mark over if you use their methodology, you're inherently biasing your quant model to buy one type of company rather than another type of company.
Okay.
And then also that the investment factor side basically says to me it's a proxy actually for saying you don't want to buy companies that are making lots of acquisitions, which is usually a bad. Net, the average acquisition loses money makes money for the people who do the transaction, the brokers, which is why we have so many acquisitions.
M&As, yeah, sure.
Yeah, but the on aggregate for companies, it's not a good thing. So there are lots of exceptions, which is why we've got such an active market in it.
Yep.
But on aggregate, you lose money on those, which is what they're basically doing with that.
Okay, sure. So that's the Farmer French models, and then I guess looking at other factors then.
Yeah. So then you step out into the broader world and see what other people tend to use. Momentum is a very common one. Now academics hate this one, and it's a bit of a sad indictment actually of the whole quantitative profession that momentum is basically has the share price gone up in the past 6 months or 12 months? If so, it will keep going up. And it's a bit sad that.
So it's an exuberance factor, an uplift or a down press.
yes and no, but it's almost embarrassing that you sort of say, after 50 years of study, we've worked out that if you buy the stocks that are going up, then they keep going up.
Yeah.
And
well, so you narrow it down and then you say, what's everyone else doing, sort of thing.
Absolutely. So there's this momentum factor, and it is pervasive amongst a bunch of markets. Having said that, I think behind the momentum factor, what I tend to think of is you're looking at the second order. You're looking at what the price is doing.
Yep.
But you actually want to know what the fundamentals are doing.
Sure.
And so the factors with these is you go, XYZ company, introduces a new smartphone into the market, and the initial things are really good.
Yep.
So the share price goes up a little bit.
Yep.
And people look and go, well, if it keeps going well, then the share price will go up another 20%. And then, a month in, things are still going well. Oh, well, the share price does go up. And then a month later, things are still going well. The share price does go up. And so it's not, people don't sort of price it in all at once and say, well, yeah, they're going to, here's what it's going to be. You get this gradual uplift as you get more and more confidence that things are keeping on going.
And I guess these obviously these incremental sort of rise you see, does that sort of have an opportunity to sort of become exponential over time? So it goes up by 2, 5, and then as confidence builds, it sort of just keeps chunking up higher rates, and then you've got the momentum drive?
Depends on the stock, I guess. But I guess it's the thing to know with the momentum strategy is it's a very high turnover strategy. So if you want to be saying, okay, I'm going to drive myself off momentum, that's where you get your day traders, and your very short term stuff tends to be momentum driven. But even as a longer term strategy, it works relatively well, but it's a high turnover. And it's one of the ones which I'll move into later. Which one of these ones when it reverses quickly.
Yeah,
so
okay.
You need to be right on top of this. If you're running this, you need to be an active trader.
Okay, sure.
Yeah.
All right. Moving on.
Yep. Some of the other ones. I'll just flick over some of these other ones really quickly. Low volatility is basically the reverse of the beta. Really, it's an interesting phenomenon that if you buy stocks that aren't very volatile, they actually tend to outperform other stocks.
Okay, fascinating.
So which is sort of the opposite to what people would expect.
Yep.
I think there's some other factors at play. Certainly over the last 20 years, we've seen interest rates falling over that time period, and the types of stocks that benefit from interest rate falling, things like utilities and telcos and sort of these very sort of safe type companies, also benefited from lower interest rates and was it sort of bond proxies?
Yeah, I was going to say, is that because they're with the falling interest rates and the sort of the impetus to push out into more higher risk markets, people are just saying, okay, well, if I've got to go into a higher risk market, find me something that's equivocal to a bond or something. Is that
exactly. As you trade up people trade up out of the government bonds into corporate bonds, and people trading up out of corporate bonds into listed equities will go, well, let me find the lowest risk.
The low vols.
Yeah.
And so is the inverse then correct though? As interest rates rise, would that be a potential for pressure on these as people move back down the risk scale? Absolutely.
And the other thing is the low vol is actually such a popular strategy that when you look at it from a valuation perspective and say, how cheap or expensive were those low volatility stocks versus the rest of the market 10 years ago, and then you look at how expensive they are now, and it's chalk and cheese. So basically you can sort of go, well, a lot of the performance was because these stocks happen to be quite cheap relative to the market, and now they're quite expensive. And so some of these strategies, you just need to take that extra step back and go, and especially because we haven't got huge time series of these, and just say, well, what is the reason for it?
Okay.
And things like low volatility, you can't really compare back in the 50s and 60s to the data because
interest rates went at zero.
But also spreads were much wider. Like you didn't have the same trading. The spreads were much wider. It was hard. The volumes were way lower.
Gotcha.
It's sort of different market in terms of the types of things you do.
Okay, and just quickly through a couple of the other ones.
So accruals is just one that's sort of looking at cash versus profit versus actual profits. Risk weighted is a way that you use to basically say, rather than just using the normal index weight, which is how big is this company, so I'll buy a lot more Apple than what I will buy a very small tech stock because Apple's much bigger.
Sure.
Whereas risk weighted sometimes equal weight stocks and just says, well, I'll buy the same amount, and sometimes it uses other methods to say, well, I'll actually buy more of the less risky stocks and less of the higher risk stocks.
And so it's sort of like a peer behind the curtain sort of thing where you're actually assessing. So what would be an example of the risk that's being weighted, just out of interest?
Valuation,
for
example.
Yeah, right.
So you might say, okay, well, I'll valuation weight everything and buy the most of the cheapest ones and less of the more expensive ones.
Okay, yep, fantastic.
Dividend momentum, which is stocks that pay dividends and keep paying dividends and solid.
So maybe a bit of a yield chasing play in falling interest rates environments. Or?
Yeah, it's also a bit of a quality thing in terms of saying companies that generally keep raising their dividends every year and the dividends don't lower, tend to be higher quality.
Yep, doing something right, obviously. Yep.
And then there's this quality minus junk is a bit of a famous paper out probably 4 or 5 years ago, just sort of looking at if you buy good quality stuff and short the poor quality stuff, you tend to win out.
Okay.
In terms of those.
Very good. All seem like very key and common sense, I guess, factors to bundle together.
Yep.
So I guess moving on to the three primary ones.
Yes. So this is the way the market, the MSCI split things up. So those were factors that people use in terms of what they're chasing. MSCI for maybe 30, 40 years have been splitting, maybe 30 years have been splitting up factors into these sort of three main elements, which is quality, value, and growth.
Okay.
So and all companies fit into one of these categories based on the way they assess it. So basically what they're saying is you're either cheap you've got good quality return on equity and low volatility and things like that, which means you're a high quality stock.
Sure.
Or you must be priced for growth.
Yep.
And that's sort of like that's the everything else category.
Okay. Oh, right. Okay. So that's your residual category. If you're not good value and you're not good quality, then there's something else going on behind the scenes. There's a story.
Then you must be priced for growth.
Yeah.
Exactly.
Gotcha.
Yeah,
okay.
You must be expensive because people are expecting you to grow.
All right. Fascinating.
And so that's the way they'll tend to look at it. The rules are very simple that they use, and too simple in a way. And because of accounting changes and things like this, they're not as correct as they were. But it's an interesting way to look at things, and it's traditionally most quants will try and sort of
put them in the buckets.
Yeah.
Yep. Okay. Sure. And smart beta.
Beta.
Yeah. So smart beta that's a fairly new term, or has it been out for a while?
Relatively new.
Yeah.
Yeah. So it's a good marketing term.
Yeah.
So,
Okay.
I've sort of put up on the screen a quote there: "Is smart beta is equal to dumb beta plus smart marketing."
Yep.
Because it does sound very good, and there's actually there's $1 trillion in assets now in smart beta as of a month or two ago.
Yep.
It's been a huge windfall for people producing it.
Yep.
And so because so much money's coming into it, obviously you produce a lot more of it. And
Yep. And off it goes. The success story until it's not.
Yeah, that's right. And it tends to be the same type of things. Somebody's backtested something and gone, I've just got a simple rule, and the rule is I buy stocks that are cheap on a price to book value.
Yep.
And that's it.
Okay.
And I run my model and I just do it and I upload everything and off you go.
Yep.
And so the problem with those factors is things do change. And so the MSCI Quality Index is a good one, a lot benchmarked to that. And so that basically uses three very simple ones. One of them is return on equity.
Okay.
Is a good example. And so return on equity is how much profit you made versus your equity.
Yep.
It used to be that write-downs were relatively difficult. So the bottom part of the way you got a better return on equity is you increased your profits.
Yep. Sure.
Nowadays, under IFRS and the way they make you look at your assets, you actually write down a lot more than we used to 20, 30 years ago. And so what that means is there's two ways to improve your return on equity. You can improve your profit at the top, or you can lower your equity at the bottom.
Write down the equity. Yeah,
and so
sure.
there's a lot more companies that are writing down their equity, and the MSCI index is starting to fill up, well, especially at rebalance time, with these stocks where it goes, the ROE's gone from 10% to 30%, and now we've put it in the index, and you're, wow, it must be doing really well. Oh no, profit's going backwards. It's just that
the company's got all, or the assets have got all that small equity.
We've written down the equity by 80%.
Yeah,
so
wow.
All of a sudden, the equity looks really good.
So there's a bit of accounting trickery in there just to game the strategy.
Yeah, and so that's the problem with the smart beta strategies, is that if you're basically setting up this thing and saying, here's what the rules are, I'm never changing it again.
Yep.
And the problem also with a lot of these other strategies is everyone knows what the strategies are, especially the ones that have got big amounts in it. So you get these low volatility strategies, for example, and I've filled up my portfolio with all these stocks where the stock price doesn't move much on a day-to-day basis.
Yep.
And then one of the stocks does move, and it might even be a jump up. It might be, great news, it's up 20% on the day.
Yep.
All the funds are then out there going, these guys all have to rebalance over the next month. They're all going to have to sell this stock, and that means X% of the stock's going to be on the market for sale. Let's get in there and short this thing before all these other guys have to, and then as they have to sell, I'll buy back my
derivative trading on the back of a strategy sort of thing.
Yeah. And so the smart betas, some of them are a victim of their own success, is that there's so much money in it that people are just looking for stocks that they're outside it and then just picking off. And the smart beta, because the rules are set and everyone knows what the rules are, as soon as that happens in the investment market, everyone wants to game it.
Yep. All right. Fair enough. Very good. Very good. So there you go. Not so smart beta. Now, obviously, quantitative analysis is hugely data driven. And so, of course, the old adage of garbage in and garbage out, I think it would be particularly relevant here, Dave?
Yeah, absolutely. So, a lot of the time spent is trying to clean the data. I've worked up three things on screen that I sort of tend to think are very important in the garbage in, garbage out. First of all, where you get the data from and what they do with the numbers. There's analysts have their numbers as to what they think happened, both on a forward perspective and an historical perspective. You get people like either FactSet or Thomson Reuters or Capital IQ, some of these big data providers who have people literally sitting and typing things in or sucking in from financial statements.
Yep.
And they come up with what they say happened. and the numbers are frequently extremely different.
Wow.
And even amongst the analyst community, you'll get people who say, and this is, I'm not talking about forecasts, I'm just talking about what happened.
The hard data,
Last year.
the reference data.
Exactly. And there's different accounting standards between different markets.
Sure.
And there's people make adjustments and people don't make adjustments. And so you just sort of go, oh, what's the price to earnings of this company? And you can get 10 different numbers depending upon who you ask.
Wow.
And so, very much, and that's the most embarrassing one of, if you're buying stocks and you're out there and you say, you've bought this stock based on all these factors and you've added up all your data, and then the next thing you know, the data changes and it's not forward data, it's historical data that's changed. You've got to go and sell a stock because, or you lose money on a stock because literally you've used the wrong data.
You've just been working off a broken data set.
Absolutely.
That's scary, isn't it? And I guess, as you say, with numerous data providers out there and researchers, effectively, as a service delivery, that's what they're doing, isn't it? They're just creating a digital, interface that people like yourself can then go and make investment decisions from. And so, what is there any sort of what's what I'm looking for here? There's no golden sort of rule, is there? It just comes down to experience, knowing that this particular organisation uses this model versus that model, and then knowing that before you actually build your calculations.
Different countries will use slightly different accounting standards, which will show up in different ways. That you'll have. It's not. I don't want to disparage too much the guys who are doing it, but as you can imagine, the people who choose to as a profession to take numbers from one statement and type into a different database, it's not the most
rigorous and reliable.
It's not the most exciting of job careers.
Okay.
And so you don't get your best and your brightest deciding that.
Yeah, right.
This is, the best and brightest want to go into the analysis side. They don't want to go into, yes, I'm going to transcribe data from one side.
It's the mailroom job, isn't it? I guess of that profession.
Yeah. And then on the analyst side, you've always got to wonder. Well, companies will say, "Oh, this was an abnormal item. Just ignore that one." And so, if you're trying to curry favour with the company, even though you think it's not a abnormal item, you might just go, "Oh, well, I'll let them have that one.
Let that one slide." Wow.
And so there's one a few years ago. Coca-Cola was a big one where they in Australia, Coca-Cola Amatil, and they had this. They bought SPC.
Yep.
And they had a write down, an inventory write down.
Right.
And so most people just went, "Oh, it's a write down. Throw it through. It's $100 million. Just ignore that, and on we go." The brighter people looked and went, "Just a minute. What's an inventory write down? That means I made something and it's not worth what I made it. So that's not a write down. That's just a loss. I made something at a price where I couldn't even sell it at that price.
Yeah, gotcha.
I was making it 60 cents a can. I could only sell for 50 cents a can.
Yep.
So I made a loss. That's not a write down. That's just a loss.
Yep.
But the way it pitched it, and then and that obviously came out a couple of years later as then they had to go back and relook at all these things and take big write downs within the business, because literally they'd been making stuff for more expensive than what they could sell it for.
Yeah, okay.
But the person who went, "Oh, that's fine,"
wave it through,
was the one who was looking at the earnings going, "Oh, no, the earnings look really good," if you ignore the bad stuff.
Yeah, right. Okay. Very good. And finally,
the different time frames.
The time frames.
So growth is obviously a big one for everyone. You get companies like Brambles a few years ago had a loss. So earnings went down for a year and then they bounced back. And so if you're looking at on a 1 year basis and you're looking at that, you're like, "Oh, profit's up 100%. Well, yeah, it's up 100%, but only because they had a really bad year. And then, take 3 or 4 years later, if you're saying, "Oh, look at the 3-year growth rate," well, if you happen to be using that low year as your base, then things look great on a 3-year basis, but you go a year forward and all of a sudden you haven't
fallen in the hole.
Yeah, you haven't got that low base. So just managing to look at things on a different time frame. I tend to try and look at things across 3 or 4 different things where I say, well, let's look at the forward numbers. Let's look at the latest 12-month rolling numbers, so sort of include your latest quarterlies and all that type of stuff, and then look at sort of various time periods backwards, whether it be a 5-year rolling averages or 7-year rolling averages, just so you sort of get a real feel for this company looks fantastic on my quant model, but it's only because I'm using numbers, very low base numbers.
Yep.
So whereas I need to be able to say if I use across any of these different things, it still looks good.
Okay.
Or,
So you need a number of confirming pieces of evidence. Really.
Yeah, that's right. And when you're dealing with big amounts of data, that the detail is hidden. That's one company in a couple of thousand that you're looking at. That detail is hidden in the bid.
Okay, sure thing. All right, very good. So that's garbage in and garbage out. Now looking at obviously the big question of course, quant works, but there's always going to be some opportunity where it might not. So what have you got for us?
So if you're looking at quantitative methods, the key thing is quant is not very good at finding the perfect stock. It's very good for screening for the perfect stock, and you can you can get down to your category and go, yeah, I'm looking for these, and I'm looking for this type of company, and now I want to get in and go and do the analysis.
Yep.
The thing is, the odds that most quant funds are aiming at is sort of in that 55% range, maybe 60%. If they can get 55% of the calls right in terms of more stocks going up rather than or outperforming the market than not, then they're doing well.
So this is going back to that having that large the casino versus the individual sort of thing. So you know the model works. You just need a lot of opportunities to get the
exactly. You want more stocks in there because you want to be able to say, well, I don't want any idiosyncratic things with the stock where the numbers were falsified or have got the wrong numbers or there was something weird with it that went on that blew up. So you'll run portfolios in the hundreds, like 700-800 stocks is not uncommon for a lot of sort of global quant managers and even US ones as well to be running just these very big models, very small bets on every single stock, but just playing the odds about going if I've invested enough stocks, this will work in the long term. But if you're trying to use it and nail down and go, right, I've just found the stock that's cheap and it's got high growth and it's got great quality and it's got all these things like that, chances are there's something seriously wrong with that stock. Yeah. And it just looks great on all these numbers, but there's another factor that you haven't taken into account.
Would you have an example of something like this in the near or the recent past?
Yeah, sure. There's depending upon which time frames you're looking at. But there's ones like I often use the one there's a Japanese stock, TEPCO, that's the one that had the nuclear meltdown. Yep. And they've basically lost the uranium, not quite sure where it is, and every year the Japanese government transfers them some more money and stuff like that. And if you look at that stock on a price to book, looks fantastic. Looks like you could wind the company up and make all this money just in winding it up.
Yep. So you actually be buying the assets at a discount and that's it. Yep.
The reality is the asset is unknown uranium in a power plant somewhere that the government's not going to let you walk away from and sell.
Yep. Yep. Sure.
And nobody's going to want to buy anyway. So
and revenues side of things.
Yeah. Yeah. And so it's a liability on that front. A lot of people would look at Blackberries and Nokias as they were falling and coming down the side, going, well, this is just a short-term blip, and look how great quality and how the margins have been over the last 3 or 4 years.
Sure.
And you got all these factors going backwards in time, and even analyst forecasts. A lot of analyst forecasts had these things bouncing back.
Built into them, yep.
But obviously that was. Your perfect quant model of cheap quality and all that type of stuff was based on the fact that it was going to return to its BlackBerry was going to come back,
and it's essentially fallen out of favour with the consumer. You just need to look at people on a train platform and what phones they've got to confirm that. Sure thing. Yeah. All right, and so next one, are you selling insurance to the rest of the market? You're going to need to explain this one, but
yes, this is the number one question any quantitative strategy that I ever see. I want to ask.
Yep,
because and this is one of these ones that comes from the Black Swan, Nassim Taleb. It's sort of a similar type of strategy. His similar type of thoughts to my own on this.
Okay.
Is that there's these strategies out there that people love to trade from a quantitative perspective, and they make a little bit of money every day. And the inverse VIX was a very similar one.
Just recently.
That blew up.
Yep.
And the thing was, every single day on that one, you've got this nice little roll where you make more money, and it feels really good, and every day I make a cent, and every day I make a cent, and it adds up, and over the course of a year, I've made $3.65, and the course of 2 years, I've made $7.20, and then I lose $50.
Yep.
And it's the thought that what you're actually doing is selling insurance to everyone else.
Yeah. Okay.
And collecting those premiums feels really good.
Yep.
It's a very positive strategy. Every day it's confirmation bias.
You're up a touch. Yep. Increasing exposure. Yep.
And then one day it's all gone.
Yeah. Right.
And there's a lot of people call them picking up pennies in front of steamrollers or things like that because these strategies that you think are making money because you're a genius. Yep. Really, you're making money because other people are trying to offload the risk.
Yeah, sure.
And so every time I look at a strategy, I need to say, well, where is it? And is there something? Is this actually just other people offloading the risk onto you?
Are you just taking the other side of a bet that potentially might explode? Okay, sure. And then while we're on the theme of I guess the pitfalls.
The pitfalls. Yeah. Look, I spoke a little bit, the return disaggregation, I spoke a little bit about that low volatility trade. And so it's a part of saying, okay, well, this low volatility has worked really well. Why has it worked well? How much of it actually came from falling interest rates? How much of it came from other factors? And I mean, there is still something behind the low volatility, but being able to break it down and say, well, X% came from the falling interest rates, and if interest rates fall from 20% to zero, that's not happening again over the next little while.
The tide will turn, go the other direction.
I'll wait till interest rates get high again before I do that.
Okay, sure.
There's also the valuation perspective. These stocks all went from being undervalued to now overvalued.
Okay.
And so there's a valuation uplift in that. And so I need to wait till they're undervalued again before I want to be investing heavily in that strategy. What other factors went into this? And so it's actually breaking it down to those.
Okay.
And so that's where a lot of models tend to be what we call overfitted. If you sit there and you never see a bad back test.
Yeah.
Someone says, I've done a back test and here's what happens. It's never bad. No one ever says they're going to lose money, because if you come up with a back test that loses money, you just go back and change your factors until you come up with one that doesn't
works.
lose.
Yeah, sure.
And what you can end up with is these factors that were very carefully designed to have this great performance for the last 10 years, but not for the next.
May not work in the future. Yep.
There's hundreds of thousands of examples of these quant strategies that have been launched with this great back test, and then all of a sudden it just disappears. As soon as we find this factor, it's gone.
It's gone. Yep.
Because you're just sitting there searching for,
And the world's a changing place,
noise.
so things that have happened in the past may not happen in the future, and pull the oxygen out of your numbers.
Yeah, exactly. And so a lot of it's coming back to that. What was the driver of this, and will it happen again?
Okay, fantastic.
And that's where there's self-serving bias. Jumping back to one of the biases before is that I think everyone's got this bias that the things that go right must be because I was really smart, and things that go wrong must be because I got unlucky. And so quant models, you really do need to make this really objective as you possibly can view about was it that I was smart, or actually really did I just get lucky? Ones? and was it because I was was it because of my strategy, or was it because of something completely extraneous outside my strategy that just happened to benefit my strategy?
Sure. Okay. And just finally on reversals.
Reversals, yeah. What is important as well is knowing what your strategy is actually chasing. There's some strategies that are sort of what I'd call pro-cyclical.
Okay.
So if I'm buying a momentum stock, I'm buying it because it's going up. And if lots of other people are following me in that strategy, we buy it because it's going up, and it goes up, and it goes up, and it goes up, and then one day it takes a tumble, and I want to get out, and everyone else wants to get out at the same time. And so, we've just reversed.
Sure.
The inverse VIX was the same one.
Yep.
All these people chasing this inverse VIX strategy, the mechanics of how you actually bought into it actually lowered the volatility of the stocks you were buying, and lowered. And but what that meant was when it reversed and everyone wanted to get out, the mechanics of you buying out of
exploded.
it, selling out of it, sent it the other direction. So, and low volatility stocks are the same. I use that example. I've got this low volatility stock. All of a sudden, it comes out with a cracking result and jumps 20%.
Yep.
It's not low volatility anymore.
Yep.
Everyone wants to get rid of it. So, even though that's it's great from and let alone the ones that fall. They're probably the worst ones on it, when you've got it in your portfolio falls 20%, and all of a sudden everyone wants to jump out of it because it was a low volatility darling, and
now it's got to go. Yeah, sure. All right. Yeah, scary stuff, and definitely things to think about. Turning our attention now to sectors.
So I won't go too deep into this because we'll have a look a bit at these in some of the later ones, but you need to modify your strategies to each sector.
Okay.
The resources sector in particular tends to be one where you need to look at the whole sector. If the whole sector is doing lots of capex, then it's usually a bad thing.
Okay.
And if there's not very much capex, it's usually a good thing.
Right.
Because nobody's out building mines, so the shortages will come, and then the prices will go up.
Yep.
For individual companies, though, it can be the opposite.
Okay.
You actually want somebody when nobody else is spending capex, they're actually out building a new mine.
Building capacity.
Yeah. And because when the demand keeps going up and the shortages come, they've got all this extra.
Yeah, all right. Fascinating.
So there's sort of issues within that, and also a lot of the measurements you use don't work out the same in resources.
Okay. So different spectacles, different quantitative spectacles required for different sectors.
Yeah, absolutely. You need to change which ratios you're looking at.
Okay.
Utilities, they're very safe, and the way they report sometimes just doesn't stack up with the way other companies report.
Okay.
And so they need to be dealt with separately. Financials report completely differently to everyone else. So how you match insurance companies and banks into this mix is can be very problematic. I mean, they generally don't have the sort of same debt metrics that you're using elsewhere. You've got net interest margins and premiums received as opposed to sales and earnings per share. And earnings before interest and tax and things like that. So lots of different things you need to use. And the last one, just say manufacturing versus services. Manufacturers tend to have very large depreciation, as I spoke about. Big capital cost, very large depreciation. Services companies tend not to. You can look at different measures about, let's say, capital expenditure. So you're running some sort of capital expenditure check on it, and you're biasing against the manufacturing companies and towards the services companies, not because they might not be better or worse companies, but just because you've chosen methods that inherently biased against one type of business model.
Favour that business. Yeah, okay. Yeah, fascinating. All right, so things definitely to keep in mind. And we'll zoom into one of our sort of final topics of where quant works and doesn't, which is the implicit assumption. So we've got a number of different factors there. Do you want to start us off on momentum?
Yeah. So what I'm looking at here is what implicit assumption is within the thought to follow a quant process.
Okay.
So if I'm buying a stock for positive momentum, I'm assuming there's no such thing as not no such thing, but I'm assuming there's not going to be mean reversion. So what I mean by mean reversion is things go up and things go down. And eventually everything comes out
at an average.
An average. If I'm buying stock because it's gone up over the last year, and so now I'm following the momentum, I'm buying it now, I'm basically assuming that isn't going to happen. That stock's going to keep going up.
It's just going to go to the moon.
Yeah. And so I need to, it's a factor that's implicit within mine. It might work for a certain period of time, but it's sort of that worth knowing that's assumed to be in the case. And that's the same with the low volatility as well. Same thing. It's low volatile now. I'm assuming it can be low volatile for a long period of time, and so there's no sort of mean reversion on that.
Sure.
Growth is the same thing.
Okay.
Value is the opposite. Value is basically saying it's cheap now relative to where it's been and things like that. There's a whole bunch of different ways you can measure value, but you're basically assuming, well, things will come back.
Yeah, obviously. If they're cheap now and they're good quality, there's no doubt everyone else will pile in, and hopefully you've got in early and can get out late.
Exactly. And so when you're following any of the sort of above strategies of momentum, low vol, and growth, you've got to be checking for the factors of, well, is this time different? Is this the time it actually does mean revert? Well, growth. I'm following these growth stocks. Growth doesn't grow forever. At what stage does it turn into X growth? If I'm following a value one, now I'm trying to do the opposite thing. I'm saying, well, I'm assuming it's going to revert. I need to be looking for reasons why it might not revert.
Sure.
Why might valuation stay low? Is it that, and it's the same type of thing with valuation. There's two ways to improve the valuation. If I'm trading on a price to earnings ratio of 6 times, which is very cheap, versus the market of trades on about 18 times, say. So that's my price is. So
it's been downtrodden essentially.
Yeah, my price is $6 versus my $1.
Yep.
Well, there's two ways I can improve that to get to the market level. My $6 can rise to $18, and now I'm level with the market.
Yep.
My $1 can reduce to 33 cents, and now I'm level with the market again.
Yeah, right.
So, the value side, you need to be very, very cognizant of which is the variable that's going to move to bring this back into play, into reversion.
Yep, gotcha. Okay.
And then finally, the quality side is you're basically assuming that quality companies will remain to be quality companies, and that's the BlackBerry example of saying, yes, it was a quality company, made these great returns, but I need to be on the ball to go, has the quality changed? And if the quality's changed, now I need to factor that into my equation.
Yep.
So, and quality stuff tends to be
quite subjective, I would have thought, in a sense.
It is. Quality measures, we'll go into a whole thing on quality measures, but quality measures tend to be trying to, I guess, objectively measure things, returns on equity and the types of things the money that's coming in. I think as a mean reversion strategy, quality does tend to revert over long periods of time.
Okay.
So you find that companies can be market leaders for 5 or 10 years, and then
over time they
change and people
fall out of favour.
And rest on their laurels and stuff like that. So but it is that part about you're assuming no mean reversion in the short term. The quality will stay where it is or get better. And
Yep.
yeah.
Okay, fascinating. All right, very good. And some key oversights for quant.
For how I use it, yeah. So I tend to want to use quant for four main reasons. In terms of when trying to get a picture of a stock. First, I want to try and ascertain the quality, and by that I mean, actually we'll move into that in a sec. So, but it's the types of does it earn high returns and is it better than its competitors?
Competitors, yep, perfect.
Predicting growth. I don't use quant for predictions, but I do use it for looking at the predictions and how reasonable they are.
Okay.
Noting that this is the weakest part of
quant?
quant.
Yeah, well, because there's a story behind the numbers that isn't in the numbers potentially.
Yes.
Tesla being maybe an example of that, perhaps. Yep.
Absolutely. Okay. Establishing value. So yeah, where should this thing be trading? Where do competitors trade at, and how has it traded in the past? And then a whole bunch of trading metrics in terms of just things that might alert you to something that's going on that you don't see.
Okay. All right. Very good. Well, we'll keep moving into probably my favourite graph. So this is a fantastic depiction and something that's a key component of investing at Nucleus Wealth. So it's a graph of high quality to poor quality on the y-axis and cheap to expensive on the x. And it, I think here is the MSCI 1600. Is that right?
Yep.
That's in there. Do you want to just quickly walk us through the green and red bars?
Yeah.
And how
so what I do is you want to buy things that are cheap and high quality.
Yep.
is best, but unfortunately you don't get many stocks that are both cheap and high quality.
Sure.
And so it's the part about saying, well, I'm actually happy if I've got an average quality stock, but it's very cheap. I'm happy to buy it.
Okay.
If I've got a stock that's very high quality but only average value,
Yep.
I'm happy to buy that as well.
Sure.
What I don't want to do is buy an average stock for an average value.
That doesn't sound like great investment.
Yeah, and so I use those green and red lines. It's underneath the green curve. Then I'm looking to buy it, and then as it's sort of moving up the scale towards the red, now I'm looking to sort of lighten up. And once it's over the red, it's actively looked at as should we be selling this stock? Sometimes there's ones where we can look at the future
Yep.
and say, well, yes, if things go well and things go the way they're forecast, it'll actually drift back into the line and trying to look at, and so we might hold a few stocks that are outside that, but by and large, it's the using that discipline to say, well, you bought this stock because it was cheap and the quality was only average.
Yep.
Now it's no longer cheap. Time to sell.
Yeah, sure. So the quality hasn't changed, but the price has, and it's now time to cut it free and have a look at the next opportunity.
Yeah,
Yep.
and vice versa though. If the quality has improved, then you might be able to hold it for a little bit longer than you would have if it hadn't. And it's more about it's not about a dogma and having this is exactly what you have to do, but it's more about saying, well, the burden of proof is now back to you've got to justify.
Being in the portfolio,
being in the
essentially.
portfolio, it's a
Yep.
lot harder to be in, and that's that getting over those behavioural biases
Okay.
you see within in portfolios.
Fantastic. Any more on this one? I
No,
like it so
that's-
much, but we better move on. We are a little bit pushed for time now, but
Quality?
yeah, moving into ascertaining quality, I guess.
Yeah, so Warren Buffett's favourite, the economic moat. So what you want to see there is you want to see high margins. So you want to see that these things are profitable, but it is a matter of measuring it against its competitors and using which lines of the P&L you're using, making
Yep.
sure you're actually seeing the operations, you're not sort of seeing other things.
Okay.
And getting into those, where are your returns versus your competitors? Are you converting the earnings to cash flow, or is it all this paper earnings that you don't actually see in cash flow? So it's sort of that thought about, are the earnings actually good quality?
Okay, sure.
The trajectory side is a bit more about the growth, so and how you're going recently in terms of how much money has been invested in the company, and are you getting good returns on that money, which is a very difficult one that's the one most people struggle with.
Yep.
Hard to do quantitatively, but you've got to try. But the problem with those is you do need to look back at the industries. So if I'm a retailer, for example, and I've just ploughed a couple $100 million into doing a store refresh, as an investor, I expect you to get a return next year, and at worst the year after that. If you're a gas producer and you're building Gorgon in Australia, and it's going to take you 7 years to spend all this money and all that before
and actually
you
get it in operation.
Get it in,
Yep.
then after the first year measuring and saying, hey, you just spent $300 million or X billion dollars, you have got a zero return, it's a loss. Is not the way you need to look at these things.
Sure.
You need much longer time frames. So that's trajectory is important, and just sort of trying to work out where that comes from. And it's basically coming back to, is your economic moat sustainable?
Yep.
So some companies are earning very high returns, but now they've had their growth, and the money they're actually investing is getting very low levels of return. And so you need to take that into account and say, well, on the moat it looks great, but at the margin things are getting worse, and so I need to then sort of
work that in. Apply that in. Okay, sure thing. And stability?
Yeah, so stability is, it's a bit like that low vol thing we spoke about. So low volatility is generally good. You prefer low volatility rather than high volatility. The thing I consider, though, is that low volatility is a second derivative. It's not something in of itself that's the share price not moving much is a look through into what's actually happening with the company. Is the company high risk or not high risk?
Okay.
So actually, are the earnings low volatility? Do you get the same earnings every year, or do you go through these big cycles where some of the semiconductor ones are great examples of that, where your Microns and your AMDs, you come up with the latest and greatest chips, and everyone wants your stuff, and you go through these 3 or 4 years of these massive sales things, and then it's somebody else's turn to have the latest and greatest chips, and your sales falls off, and your earnings fall down, and then you're into your next.
And you're
cycle.
in R&D mode, I guess, for the next wave.
Yeah, and so those guys, the stability of earnings is not very stable, up and down all the time. Whereas there's other companies like your utilities and property and things like that are just churning that same cash out every year, and it's up and down a little bit, but they're very low, very predictable earnings.
Sure.
And so so that stability is an important factor, just as to how much you want to pay for a company.
Okay. And finally, on the financials.
Yeah, so just making sure you haven't got too much debt. Really, is the
it's the primary look.
Yep, 100 different ways to measure it, but really it's and it does interrelate with that stability. And so I've got a few things just about saying, well, I don't mind a company having more debt if they've got very stable cash flows.
Yep.
If you've got your cash flows aren't very stable, though, then you don't want to be having much debt.
Okay, sure. And for more on this one, we're going to be running a separate quant quality deep dive as well. So we'll shift over and also on growth as well, I believe. Yep.
Value.
And value. Sorry, value.
So the growth side is it's that the most important thing to remember with growth is that humans are not very good at predicting growth.
Mm-hmm.
They're actually quite bad at it.
Okay.
The range spread is pretty incredible when you look at these things at any number of years. Dartboards and all that type of stuff. There's discussion over whether the last year is actually just the best predictor or is it analyst forecasts, and it does sort of vary. Computers generally are worse, so anything that sort of comes out and says, well, I'm predicting that this is what the number is based on some sort of computer algorithm that I've generated, is generally going to be worse than the humans.
Okay.
But there are exceptions. So, and the odds are the exception is not you, though. If you think you're a genius at forecasting these things,
you're probably wrong.
You're probably wrong. Yeah, that's right. And I'm not putting myself in the camp of being a genius forecaster either. I think most in general. Trying to predict company earnings is very, very difficult. There are the exceptions for me are coming back to the size of the company.
Yep.
So bigger companies are a lot more predictable than smaller companies, and it tends to be because you've got business models that are very long lived and you're in multiple markets.
I was going to say diversification. So so you've got your finger in many pies, so you can afford to take a couple of losses in order to have a win.
Yeah, absolutely. And just a net aggregate of you've got 6 or 7 different businesses in 6 or 7 different countries. The odds of them all turning up at the same time or all turning down at the same time are relatively low.
Okay, sure thing.
Coverage. So if you look at analyst coverage of stocks, if there's only 2 or 3 analysts covering it, the chances are those 2 or 3 analysts are trying to get deals.
Right.
They're so the way when someone says they're a broker, there's 2 things they're a broker for. One thing is a broker for you as a taking your money and going and buying stocks on the market.
Yep.
The other thing there is broker for companies raising capital. And
sure.
So their thing is, the company wants to raise capital. They want to find investors who are willing to invest in this company,
and the broker's the middleman.
And the broker's the middleman.
Yeah. Okay.
And if you've got a company that's very highly acquisitive, and we spoke about highly acquisitive companies not being that good.
Yep.
Brokers love them because there's lots of
Good
fees to come
turnover.
out of. Yeah.
Okay.
And so if there's only 2 or 3 analysts covering the stock, 2 or 3 brokers covering the stock, chances are all of them, or at least a majority of them,
Are in the pocket.
not so much in the
Hider
pocket,
brokers out there.
yeah, that's right. They want to get the deals. And
Yeah.
so the numbers, when the company says these are our numbers and this is what we think we're going to earn next year, the brokers go, that's great. I might put that up a little bit, but chances are I'm not going to put that down a little bit, regardless of what I think.
Okay, sure.
And so the if you've got a broad coverage, you're more likely to get a bit more of a reasonable expectation on it.
Okay.
Otherwise, your numbers are very much optimistic in terms of what you expect it.
Okay, and just quickly through the remaining.
Yep, the time frame.
exceptions?
So if you're looking at forecasts that are 6 months out
Yep.
or 3 months out, they're generally pretty good.
Okay.
If you're looking at anything from a year to 2 years out, it's just a bit of a scattergun, and 3 years out is
Forget about it.
Forget about
Yep.
it. Yeah,
Okay.
It's the dispersion of it. So analysts will tend to be very tightly clumped around. So the company will come out and say, we think we're going to do 10% growth next year. And somebody will come out and go, oh, no, I'm super bullish on this company. I'm going for 12%. Somebody else will go, no, I'm super bearish. I'm going for 8%.
Right.
And so you've got all these analysts between 8% growth and 12% growth. The real range will be something between 10% down and 30% up.
Wow.
Just statistically what you see from companies over that time period.
Sure.
But the analysts are all sort of grouped around this very
Around the
close-
given figure.
Yeah.
Yep. Okay, so they're really just taking it and tilting it on a couple of factors that they think are more important than the estimator
And
originally.
very much in the first year. It's not an analyst forecast. The first year is a company forecast of what they think, and
Yep.
they'll not as explicitly as they used to, but the analyst will get the message that they'll get a call from the guy and say, oh yeah, I just saw your research note and having a look through the numbers. Wow, you're being really aggressive with your growth forecast. You know?
Okay. Yeah.
And it's that type of, or wow, you're very bearish on those. Have you seen what's happening in this? And so it won't be a raise your numbers, lower your numbers, but if you can read between the lines, then you'll know, oh, my numbers are way too low. I need to
Bump them up or do whatever. Okay.
Yeah.
Yep. Finally, industry.
Industry, the industry that you're in makes a huge difference as to how good the forecasts are.
Okay.
Resources in particular, forecasts are terrible.
Mm-hmm.
Having said that, if you break into the actual numbers, the cost forecasts tend to be pretty good for a lot of these. It's just that they've got no idea what the earnings are going to do. The sales, side's going to do. And often it's not the same analyst anyway. Often there'll be one analyst he's covering XYZ resources stock.
Yep.
Somebody completely different possibly in a completely different department is doing the currency forecasts, and somebody else is doing the commodity forecasts. And so it's sort of a bit all care, no responsibility in that, look, I've done my numbers forecasts. Here's what I think the costs are going to be. The sales numbers, well, I've done the volumes, but the two biggest factors, the currency and the commodity price, have come from complete strangers.
Not my department. Yeah.
Yeah, exactly. Not my department. So, your focus is on getting your cost numbers right. And
right.
And so what you tend to notice with the resources companies is 2 years out, absolute scattershot, could be anything. Once you're 3 months out, we've actually locked in 9 months of your prices and your currencies, that analysts they're as good as any other, and better than some sectors.
Okay.
In terms
Yeah.
of those
Sure.
sorts of numbers.
All right. Very good. So we'll zoom just into establishing values. So what are some key thoughts
things
here?
for value. So we want cash flow, earnings, balance sheet, and returns are just four of the things I look at. So cash flow wise, it's important to look at a number of different types of cash flow. Free cash flow is the most common one most important one where you're trying to get their cash flow and adjust for capital expenditure, but that's very difficult to get to. We'll go into a whole thing on that.
I was just going to say we have got the upcoming value deep dive as well. So
I might leave these. It's important to use a few different measures though. Looking at both cash, your actual earnings, what's on your balance sheet, what's not on your balance sheet, and then also, are you actually getting sustainable returns in terms of dividends or buybacks or things like that capital returns that's coming back to you as a shareholder?
Okay, sure. And then finally on trading metrics.
Yeah.
So momentum.
So momentum. So it's important to have in your models, I think. I'm not a momentum investor myself. I just think the trading's too high, and you do get to see sudden sharp reversals.
Yep.
But it is worth looking at. It is a factor that works, and so it's worth looking at it in terms of when you want to buy a stock and the momentum's terrible, you should at least know that the momentum's terrible, and it's a sign to me I need to go and have a closer look and just make sure, am I really happy with the value? Am I really happy with the earnings behind it? You
Yep.
know, is this a $6 stock? Sorry, is this a $6 stock with $1 of earnings? If I think it's going back to 18 times, is it because the price is going to increase, or is it because the earnings are going to fall?
Yeah, gotcha.
So
and so yeah, in a sense, it's a sort of a secondary thought that just helps confirm a foundation of an investment decision.
yeah,
Okay.
just that extra look at it. The other thing on momentum as well is earnings revisions and dividend revisions. So actually, do want to look at our analysts revising their forecast up, or are they revising them down with that same thing? You know, I might think it's good, but
Yep.
if analysts keep revising their numbers down, then maybe there's something more that I need to be looking at.
Okay.
The derivatives, so looking at other markets, so things like there's these things called CDS spreads, which is basically people making bets on the debt of a company.
Okay. Yep.
And so if you look at a company and all of a sudden people are starting to make basically buying more insurance for themselves. I need to buy more insurance because I think the company might go broke.
Okay. Wow.
They're the ones where you're just sort of going, okay, well, if the CDS spreads are starting to blow out because people are worried about it going broke, okay, now I need to have a double check. Is it really high quality, or is it the quality lower than what I thought?
What do they know that you haven't found yet?
Yes, absolutely. Option pricing is another one.
Yep.
So you get some interesting ones in the option market. So are people actually out there buying lots of puts on the stock, or are they out there buying calls? So
Yep.
and seeing where the spread is. So is this something where, is it a stock where people are worried about it falling, so they're buying puts, or is it a stock where they think it's going to rise? And so
Okay.
so there's some interesting things you can get out of that. Again, just that not something I'd directly go and buy and sell a share based on this data, but it's something I'll use as a
It's like an indicator, a small, yeah, like a
indicator-
tell on a sale flag. That, you know, you've got the full thing of wind.
Absolutely.
Yeah.
Do I need to go and have a closer look at some of the other numbers? Corporate actions are important. So you get these there's takeovers. You get if companies are doing buybacks, there's going to be some effect on the share price from that. If the stock's going in or out of an index, or some of the factors have changed that you might see in popular quantitative things. So I spoke about stocks jumping or falling, and then they drop out of volatility indexes. You look at short selling.
Yep.
Short selling, I find it's a little bit of a like a lot of things. It's a little bit about where it is and also where it's moving. So
Okay.
there are times when stocks are just filled to the brim with stocks short sellers,
Yep.
and the stock actually ends up rising because all the short sellers that can possibly sell short have sold.
Yep.
And actually, they do need to buy back their positions at
Some point. Yeah. Okay. Yeah,
And
well.
so you sort of want
Have you got a recent example of something like that happening?
plenty of short squeezes you can see.
Yep.
But the stocks where you'll find is that it's the movement in that. So if a stock's sort of moderately short sold for relative to its own history,
Yep.
and there's more and more short sellers
Jumping in. Yep.
okay, now that's a bad sign. I want to have a bit of a closer look.
Yep.
The fact that a stock's got stacks of short selling, but it's not increasing very much, and it's sort of at its limits, may be a negative sign, may actually be a positive sign that they need to buy it back in the short term. And so so I'd sort of short selling I'll look at as a again, not a factor that'll drive you out to have to do something, but
It's a good check.
something to have a closer look.
Sure. Okay. And finally, on market news.
Market news, yep. So things like and things like insiders buying and selling. So you get like directors' sales of shares or buying shares.
That's always a fascinating tell, isn't it? Yeah.
What are they doing, and why are they doing it, and things
Yeah.
like that. So we've obviously seen a big thing recently in terms of some margin lending in a.
It's a pizza distributor creator.
That's right. So sort of questions about what's going on there, and other market news. Analyst sells, so analyst recommendations. Most institutional investors don't pay much, if any, attention to.
Yep.
The sell recommendation has got some information behind it though. So stocks that do have a number of analysts with sells on it is
Yep.
again worth looking at. It's a little bit like short selling though as well. Is that if there's a lot of analysts out there with sell recommendations, it may be that that's all the bad news is in the market. Everyone's already on that side of the boat,
Yep.
and they've already pushed through, sold everything that's going to sell, and so
when the tide turns
the only way to go is for analysts to start upgrading their recommendations and pushing around. So again, I treat it a bit like short selling in that a couple of analysts with a sell might be a reason to have a look at it, and more analysts becoming more negative, sort of moving buys back to holds and holds back to sells and things like that, can be a worse sign than just seeing a lot of analysts out there with sell recommendations, because that's sort of maybe the story's over and it's actually time to move back in.
To move back in again. Okay, fantastic.
And then in the market news as well, there's lots of sentiment, text analytics, and there's a sort of a whole different scope of things you can do in terms of trying to pick up these signals that, and one of them is complexity they'll like to use, that language tends to get more complex when things are getting wrong. And you can pick this up within analyst statements and looking at transcripts of conference calls and things like that. And so the idea is that when I've done a good job, it's very easy to tell you that I've done a good job.
Just put your numbers up and book your holiday.
Exactly. My earnings are up 15% this year. Our sales are up. Everything's going well. End of story.
Yep.
As soon as it starts to become a bit more complicated, so as soon as the story is not so good, it's, our earnings weren't quite up as high as what we thought, but this happened and Trump happened and that happened over there and something else went on. The story's always a little bit more complicated.
The smoke and mirrors start to come out of perhaps.
And if they're full, and then the story's really complicated. We were unlucky over here and unlucky over there, and this, and so and you can pick up that in the text often a little bit earlier than you can see it in the numbers. In that already they're starting to craft their excuses, if you know what I mean.
Yep.
Like it's
they're building a narrative.
Yeah, that's right. Things have been great, but I know that the last month or so hasn't been so good, and I'm worried about this, and I'm worried about that. Let me start building that narrative. So
feathering that nest for me to fall into.
So that that's right. In 3 months' time, when I report my next set of numbers, I told you this was happening.
Yep. Yeah, right. No, that's fascinating. Great one to finish on as well. So on that note, we will draw this segment of our quantitative analysis deep dive to a close. It's been a very full session, actually. It's been great. So thanks very much, Damien, for sharing with us your thoughts and tools and obviously what goes through the minds of a fund manager when you're engaging in quant analysis and making it work for you. On that note, we'll quickly jump across to some notes about investing with us and how we use quantitative analysis in our investment models on a retail level in order to help build you wealth. So stay tuned. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. Okay, and also coming up, we've got our second edition of Quant Rocks for Selecting Stocks, in which we'll be doing a deep dive into the quality side of quantitative analysis. I've got the date wrong there, unfortunately. Sorry, it's same bat time, same bat channel, the 8th of March, 12:30 Australian Eastern Standard Time. And so look forward to catching you then. If you'd like to register your interest, please head over to proton.nucleuswealth.com. Also, just a quick shout out that we are planning, for those that are up in Sydney, we are actually planning on heading to Sydney for the Australian Fintech Business Awards. We're lucky enough to have got a nomination for that one for the Financial Advice Innovator of the Year Award. And we are looking for anyone that's interested in catching up with us. We're looking at just getting some expressions of interest for a couple of different time slots. We've got a lunchtime, an afternoon, I think on the Thursday, and perhaps a Friday morning. So there's some emails coming out, or we might even tack it onto our survey that Matthew sends out, just to give you an opportunity to, if you'd like to come along. We'll run probably a 1 hour session, perhaps with a little bit of a market update and also some Q&A, and David will be along for that one as well. And also with the survey there, just feel free to give us a bit of feedback on how we've gone today, and also any further topics that you'd like to hear about. So on that note, thanks very much for your attendance and for listening in today. I hope you got something out of it on that big wide world of quantitative analysis and how Nucleus Wealth engages with those processes. And we look forward to catching you at the next one. So cheers.